Refinance payoff calculations and making your current payment are one and the same to some degree. I mean, they are, but they aren't. Here's what I mean. When you're looking to refinance a home loan and we order the payoff, the mortgage company orders the payoff or gets the payoff. The refinance payoff calculations are going to be different than what you think. Meaning, if you're going to tell me, hey, I owe $300,000 on my home. Cool. Well, first of all, that's a round number. So let's say somebody says, hey, I should owe, looking at my mortgage statement, 301, comma, $552.49, right? Whatever they see, they're going to say, hey, this is how much is left on my statements. That's actually incorrect. And here's why. That's what your statement says you owed at the time of that statement. But when you potentially could have made payments since, right? So the refinance payoff calculation goes this way, and I'll tell you how that payment has an impact. So when we order a payoff, you got to remember mortgages are paid in arrears. That means backwards. So let's just take a closing that's going to happen on June 20th, let's say. So June 20th, doesn't matter the year, just June 20th. And as a good homeowner, we'll say in this instance, Joe homeowner has made his June 1st payment. He pays right on time. Good for Joe. And that's where Joe on June 2nd can tell me, Mortgage Mark, hey buddy, I owe 301, 50 and 49 cents or whatever dollar amount it is. That's accurate on June 2nd. Well, here's the deal. Joe's going to live in that house, obviously, until closing or refinance. Doesn't matter. We're refinancing here, so we're not selling it. So Joe's still living in the house, or even if he not owns the house, because it could be an investment property. But Joe owns the house, and there's still a mortgage, which means when Joe made his June 1st payment, all he did was pay for May, the month before. He paid for May's interest. So therefore, June 1 through our closing date, let's say closing and funding is June 20th. So we closed on June, I don't care, June, whatever 3 days is before that, depends on the weekends and stuff. Because when you refinance on a primary home, there's a 3-day rescission. Let's not complicate with that. But let's say it funds on June 20th. Well, until that loan funds on June 20th, Joe has not made June 1 through June 20 interest payments because that normally doesn't come till the July mortgage payment because again, it's paid in arrears. So they're going to take the payoff plus that extra 20 days in this example to add to the payoff. So whatever the per diem interest is, per day interest, that gets added to the payoff. Now, in addition to that, mortgage companies, mortgage servicers, they'll typically charge $75 to $150 of a fee on there. Okay, fine. Whatever they're doing to get us that information, I'll know that it's worth the 75 to 150 bucks, but they charge it. It is what it is. You got to pay it. So add 150 bucks in our example to that. Then mortgage companies, we do it on purpose, intentionally, for a good reason. We will typically ask and require the payoff. In this example for June 20th, we'll probably pad it for 2 days, maybe even 3. So June 22nd or June 23rd. So there'll be an extra 2 or 3 days of interest. And you're thinking, hold on now, Mortgage Mark, I want my money, and I'm not going to pay for something I didn't pay for. And you're correct. But we pad that payoff for an extra day or two because if the wire shows up late, just after funding happens and all this stuff, and the title company doesn't disperse and do what they're supposed to do or whatever it may be, if it's 1 penny short, we got to do the whole darn thing again. So by adding that extra day or two, if the wire doesn't get there till the next day and the loan technically didn't pay off, even though it's supposed to pay off on June 20th, we want to make sure that the money actually didn't hit to because once it closes, we send money to the title company, and title then has to send it to the mortgage company, the mortgage servicer, to get it paid off. Well, if just maybe the closing was late in the day or funding's late in the day and the money doesn't hit the servicer's account till 6/21, we want to make sure there's enough money there to pay that 21 days. Even though we were hoping for only 20, we'll pay the 21 days. So the good news is, if it goes as planned, which it does 99% of the time, but if it goes as planned, that extra 2 or 3 days, there'll be a refund check coming to you after it's all said and done for that excess amount. It's not going to be a lot. It can be 20, 30 bucks, whatever it is, depending on your mortgage size and your per diem interest. So the refinance calculation, payoff refinance calculation, again, it includes your per diem interest plus a payoff fee, whatever they want to charge you, and then maybe 1 or 2 days for a buffer on the actual payoff in addition to the normal per diem interest. So now, what I mentioned as we started this thing about making your current payments, So in my example, closing June 20th, let's say Joe homeowner just really, it's kind of hard up for cash right now. And Joe just says, man, Mark, we're going to start this process in mid to late May, and we're going to try to close and, let's call it a 30-day closing. Calls us at the end of May. Joe needs and wants his cash. Joe decides with our counsel, we're going to tell Joe, don't make your June 1st payment. So by not making Joe's June 1st payment, what happens is now in this scenario where we close, keep the same June 20th, by not making that payment, his refinance payoff calculations will be, and we explained this to Joe. Now, because he didn't make June 1st payment, he has 30 days of May, right? Or I guess 31 days of May, technically. 31 days of May's interest that's going to get added to that payoff in addition to June 1 through June 20, because he didn't make the June 1st payment, which pays for May's interest the month before. So you get all 31 days of May plus June 1 through June 20, because he's not made a July payment because it's not July. So on one hand, Joe gets to keep that extra payment in his bank account, but he still owes that interest, and that's what gets added to the payoff. So the payoff goes even higher. But for Joe, the convenience of keeping that extra month in the bank account is really helpful. Now you may be thinking, well, gosh, after the 15th, isn't it late? Yeah, most cases it is, but it doesn't go against your mortgage, your credit report, because it's not 30 days late. So Joe, when we get this closed and funded on June 20th, there's most likely on that payoff going to be another $75 fee. So the $75 late fee is for him not making his mortgage payment before the 15th. And again, we explained this to Joe, the same we're explaining it to you now. And so Joe, again, keeping that extra $3,000 or whatever his mortgage payment is in his bank account, that's super helpful to him. So he doesn't mind paying the $75 late fee because he just figures, man, that's kind of like the cost of keeping the money in the bank account. So again, when refinance payoff calculations and making your current payment come together, it's kind of a neat way to do a little mini cash out. He's not taking cash out, but he gets to keep that money in his pocket. And then all that interest from May that he didn't make in his June payment gets added to the payoff. So does the June per diem interest and that 1 or 2 extra days. Then a payoff fee for the $150, give or take, whatever the mortgage servicer charges, and then a late fee of $75 in this example. So you can see how when somebody says, hey, I owe 301 and some change, $301,550.49 or whatever that number is, the reality is the payoff may show up at 303, 628, whatever, right? So it's going to show up higher. If he doesn't make the mortgage payment, then all that interest is going to get added. So it's kind of like making the mortgage payment at closing, but you get to roll it into the loan amount. So you get to keep the money in your pocket. So I know that's a lot, but I think that's worth noting because, again, the reality is when you close, so if we fund in this example, June 20th, Joe doesn't have a mortgage payment until August 1st. So again, Joe gets to skip that monthly payment. Like when you close on a mortgage, in most cases, you get to skip. And the reason being, so all those calculations we just do is the refi, calculation for the payoff. That's what's owed. And that gets Joe current through 6/20. Well, at closing, the mortgage company, us, the mortgage mark team, there'll be on the CD, the closing disclosure, per diem interest from June 20th through the end of June. So all of June's interest gets paid. The first 20 days are going to be in part of the refi payoff. And the last part of June is going to be on the per diem that gets charged on the closing disclosure. So all of June's interest is taken care of, which is why he gets to skip the July payment. Because remember, July pays for the month before. So since all of June's closing or interest is at closing getting paid, you don't have a July payment. The August 1st payment pays for the July interest. So that's how payoffs work for refinances. I know it's complicated. At the end of the day, just know that it's regulated. Complicated, yes. Regulated, absolutely. It's going to be what it's going to be. There's not a whole lot you can do unless you just want to pay more money, whether you pay it in terms of a monthly payment or pay extra. If you don't pay it there, you're going to pay for it at closing. So money's going to get paid, obviously. If you owe the interest, it's going to get paid. If you have questions, reach out to the Mortgage Mark team. We're certainly here to help. We're happy to walk you through that whole process again if needed. As always, just know that we're here to help. And when you think mortgage, think Mark.